the numbers are pretty stunning here. According to your research, we've got 145 new campaigns in the first 2 quarters against 136 companies. Why have we seen such a rapid pace?
Yeah, it's incredible. And those 2 quarters represent over 70 attacks each quarter, which is a high watermark for the quarterly rate. There's 3 reasons we're looking at. One is the M&A market with a $2.5 trillion sort of fuel of M&A deals happening. It's driving shareholder activism. In 1/3 of the activist situations, there's an M&A thesis involved. So with more M&A happening, there's more room for activists to work. The second reason is the hunt for alpha. Valuations are extended in the United States. Long-only investors, traditional investors, hedge funds are all looking for edge. And the third thing is there's been an emboldening, really, of the investor market by what's happened over the last few years in activism. Boards are more receptive to activist ideas. Management teams are engaging versus fighting. So I think there's a number of factors driving it.
Speaking of emboldening, you had mentioned to me before that you're seeing more people join what you call the $10 billion club.
Yes.
People putting more money, large sums of cash into these campaigns. I'm wondering kind of who's joining the $10 billion club. Are we seeing people catch up to Elliott, who's been the behemoth in the space?
Sure. Elliott, clear leader, represents about 12% of the overall activism market. But now we have 6 hedge funds with $10 billion deployed right now in activism situations. Third Point, Value Act, Icon, Jana Partners, Cevian in Europe, TCI. It's a big group. And another interesting statistic is that even though Elliott is representing about 12% of the market, 110 unique funds used activism as a tactic this year so far, which is a record.
Now, you advise the companies that are the targets
That's right.
of these various campaigns. And sort of anecdotally, it feels like most of the time they're successful. The activists are successful in their various quests. The companies that you talk to, are they receptive in most cases at this point?
What I'm finding, and it's a big shift from 3 or 4 years ago, is that the initial reaction was always, no way.
Right.
Let's go punch that guy in the nose. We're not, you know.
Because it feels like an attack, a criticism, right?
It's it's often personal too, and it's a criticism of a strategy that many board members and management teams feel like they've taken years to develop, and then an investor comes along and says you're wrong or you're half wrong. So what I do find, given the pace of activism, that boards are now more receptive. And with over 700 board seats having been handed over to activists in the last 5.5 years, the board culture is now different. They're telling management teams, what are we doing to get prepared for an activist thesis? Whereas 50% of my time 3 years ago was running proxy fights, it's now 30%. 70% of my time is now used just to prepare companies during sunny day situations to how they might be vulnerable and get them ready.
But it's not just board receptiveness, right? It's also shareholder receptiveness. How are shareholders behaving? Long onlys, people who are non-traditional in the activist space.
I'm glad you brought that up, because the most interesting development of 2018 is what we're calling the new vocalism. There is a new velocity by traditional investors. I'm talking about Wellington, T. Rowe Price, Neuberger Berman, Clearbridge, Janus Henderson, Standard Life, who are willing much earlier to take sides. And they're willing to, they don't want to wait for the proxy fight. They're letting management teams know earlier, I'm on this side or I'm that side. And that's become a big driver for the market.
Well, they want that alpha too, I guess.
They want the alpha too. And they're frustrated, frankly. You know, if you look at some of the proxy fights that take 3 or 4 months, cost tens of millions of dollars to run, and activists, you know, sort of go around talking to folks saying, I represent the shareholders. If you're a $1 trillion asset manager, you know, you want to stand up and represent your own views. AllianceBernstein's calling it the Megaphone Effect, how they can use their long-only positions.
Now, it's been interesting, speaking of people taking sides, that you have different activists on different sides in some cases, or different well-known shareholders. The most recent example, very recent, Cigna, Express Scripts. You had Icon on the one side, you had Larry Robinson, Glenview on the other, and it turned out that basically Icon said, okay, which doesn't happen very often.
And quickly, too.
Exactly, quickly. So it didn't take that 4 or 5 months that you're talking about. What do these guys have to gain when they're sort of fighting against each other?
Well, not a lot. But what happens is that as you broaden out the tactic, you're going to have more players who all are discovering, a vulnerability to a particular company, but they're going to have different answers. Look at Newell Brands earlier in the year. We had the Starboard Icon kind of cage fight that went on for almost a couple months. But I'm not surprised by it. There's more players. It's not just Elliott. There's more players all identifying the same vulnerabilities, but with different ways to solve it.
Do the other shareholders lose out when the activists are cage fighting like this?
Well, they lose out in the sense of it causes distraction. It takes long enough to deal with one activist. When you're dealing with two activists with different solutions, it's a big stress on management teams. So I think that's another reason why we're seeing this new velocity in traditional shareholders wanting to get involved. They're like, don't waste time on that. We're going to come out this way. We're letting you know early. You can communicate that back to the activists and try to solve this sooner.
Are there some activists that are easier to deal with than others?
Certainly.
I want to name names.
I have what I call the spectrum, and you're somewhere on the spectrum. No, there's certain activists whose approach attempts to be more constructive when they're dealing with companies. And those activists tend to call companies in advance before they go public with a thesis. They also focus more on what I would call operational issues versus sort of transaction catalysts. So they're not pushing companies to sort of go in a particular direction in a short period of time. They're focused more on the longer term performance of the company. When you have a behind-the-scenes operational thesis, I think it's easier for management teams to handle that.
How much of this is driven by pressure on active managers in general?
I think there's significant pressures coming from the macro changes in the asset management business. We've been watching two trends for the last 3 or 4 years. One is the rise of passive, which is driving down fees generally across the market, and the second is the concentration of ownership. So you're having fewer players owning more of most public company equity, and they're trying to distinguish themselves as they collect assets. So I think the macro trends in asset management are a big driver of this.
Is it ultimately a good thing? In other words, do you increase things like board accountability as a result of these activist campaigns in general?
I think the good thing that has come out of activism is that boards and management teams are doing two things. One, they're taking a hard look at their own vulnerabilities, and they're not doing it just in a sort of an internal framework. They're asking external advisors to come in and play the activist, and that's good to look at your vulnerabilities from the outside. And then the second thing is that board members are getting more involved in shareholder engagement, and that's the best defense for activism, is knowing what your shareholders think.
There's also more than $10 billion from 7 different funds now at a time being deployed into these campaigns. What's the risk, and why are the sheer volumes getting bigger and bigger?
Well, I call it the bifurcation. So certain activists have been practicing this for a while, and they're getting larger allocations from their LPs to pursue this strategy. Rather than having that money spread over 15 or 20 positions, they're focusing it on a few names where there's a lot of liquidity in the stock, so there's different ways to make money on the credit side, the options market, and they can focus their research efforts on those particular companies. Also, with larger companies where you have to take a larger stake, the business models are more complex. There's more to do.